Jeff Kleintop and Collin Martin are with me here to talk some big picture ahead of tomorrow. Jeff, of course, the Chief Global Investment Strategist. Collin, Director and Fixed Income Strategist. Our regulars here on the big picture panel. Afternoon, gentlemen. It's all about bonds tomorrow, right, Collin? I mean, we're going to get some decision earlier this month. It's all about steepening. Then it's about flattening. When's the bond market going to make up its mind?
Probably not for a while, Oliver. You know, we're seeing the inflation data come in, month by month. It's moving in the right direction. But I think the question now is, when will that peak be? We're looking at relationships between previous peaks, how long it takes from a peak to a cut, and what that means to the yield curve in terms of will it continue to invert or can it re-steepen? If you look at past instances of Fed tightening, once the Fed hits its peak, the yield curve doesn't really uninvert due to a rise in long-term yields. So from our outlook here, it doesn't look like there's much of a change. Maybe there's some modest upside with long-term treasury yields, but we think we're probably stuck in this current range that we're seeing right now, probably in that 4 to maybe 4.5% range, but we're not there just yet.
That is such an important point that I know we've mentioned a few times. We've talked about here before the uninversion of the curve when the typical cycle starts to go into recession. To your point, it doesn't really happen from like growth magically coming back. But that's what was going on earlier this month up until like 2.5 days ago, right? I mean, is it not kind of crazy that that's what was happening, a organic, healthy bear steepener in the yield curve?
That was the main driver, Oliver. If you look at what drives the yield curve and why we're seeing the inversion right now, it's based on expectations of a potential cut down the road, but that clearly keeps getting pushed back. If we were to have perfect foresight and know with certainty that, let's say the Fed's going to hold at 5.5% right now for the next 10 years, and because of strong growth and stable inflation, in that instance, we'd probably see a flat yield curve. You'd see all treasury yields right around 5.5%. But as long as the markets are pricing in an additional slowdown in inflation and potentially slower growth resulting in those rate cuts, that's why we have the inversion. But if we continue to get better than expected data, then that could pull long-term yields up a little bit.
Okay. Of course, that's not the situation the last couple of days. To your point, we kind of, put the kibosh a little bit on some of those hopes with what Jeff describes as more forceful easing in the labor market. Really well said in your notes there, Jeff, on the last couple data points, right? Because we knew there was easing. This being more forceful is I think, good way to describe, I guess, why the market reacted the way it has.
Yeah, so you had the weaker than expected job openings data yesterday, and in the midst for ADP jobs data today, with the U.S. adding the fewest jobs since March, adding to the sense that the labor market is finally easing more forcefully. I know I've talked a bit about on your show about how many layoff announcements we've seen, and there's been a steady trickle. It's not overwhelming, but this is something that's happening from the bottom up. As I travel around the U.S., talk to a lot of small businesses, and see this in some of the Fed Beige Book and several other places, what we're seeing is the tightening in lending conditions that has taken place, other conditions that have really caused more layoffs in areas that aren't counted in the establishment survey, right? In the numbers we're going to get Friday are big businesses and the jobs that they're hiring or firing. What I'm seeing more is at the bottom level of this, smaller businesses, businesses that have maybe 50 employees or less. They're more struggling to, the florist to buy that another truck, to, the pizza shop to hire another worker to staff in the evenings. That's the type of thing that's pulling back a little bit here. I think that is beginning to show up in the labor market, and that's one of the reasons why we've seen this kind of movement here lately, a bit of moderation in the outlook for growth.
The ranking of what matters to the dollar and bonds, Jeff, do you think inflation still is number one? I mean, even if we do get forceful easing, but inflation doesn't come down, I mean, like, that would take, I guess, preeminence in the Fed's decision-making process, or would it? I don't know. I mean, if employment forcefully eases, but inflation, beats hot tomorrow, does that have potential to put us right back into the grinder?
Maybe in this case, I guess it was not just a very tight labor market that drove up inflation the way it did. It was all kinds of other factors as well. So I think if we just had, if we had an easing labor market and we still had some sticky elements of inflation, notably housing, I think the Fed could begin to look beyond some of that stuff. But I think central banks around the world are really challenged with this very tight labor market. It's not just here; it's in Europe, it's in the UK, it's in Australia, it's in Canada, it's around the world. And so any signs we can see in the most timely, the country that releases its data on the most timely basis is the U.S., whether it's initial jobless claims on a weekly basis or on the first Monday of the month. When we get that the overall monthly jobless numbers, it's really, or the overall employment numbers, really good to see a leading trend in the U.S. on the labor market. And that's really important, I think, globally. And one of the reasons, maybe we see a little bit of a stumble in the dollar here, particularly versus the pound, on perhaps a weakening picture here in terms of what the Fed might need to do.
Okay. Another thought on bonds real fast, but on the corporate side, Collin, as we saw this repricing in treasuries the last couple of days, is there anything showing up in credit spreads that would suggest an alarming deterioration signaled by these recent data?
Not in credit spreads. Credit spreads are behaving basically the opposite of what we would have expected given the environment we're in with such an aggressive pace of Fed rate hikes. Even today in the GDP report, we saw some disappointing corporate profit data where we've seen 4 quarterly declines in core profits. But if you look at what spreads are doing specifically in the high yield market, they continue to tighten. They're at their lows of the last 18 months or so, which shows that the markets, investors, lenders just aren't too concerned about what we think is a relatively risky environment. So right now, not really, seeing too many warning signs, but we're still a bit cautious, and we're not suggesting that any of our clients take too much risk in the credit markets right now.
Okay. Hey, Jeff, to that point on the global stage, give me the 30-second China update today while we take these bells.
The Country Garden. So reported earnings today. We know that's the big troubled real estate developer in China. They've had a loss of $7.1 billion in the last 6 months, the same as Lehman Brothers in Q2 and Q3 of 2008. But we don't see a Lehman moment here. Yes, those bonds are trading at 8 cents on the dollar, but other high yield bonds in China are not. That's a suggestion that we're not seeing a lot of contagion from China's depressed property markets across the rest of China or the global markets.
All right. Nice. Great 30-second drill there. Excellent convo, gentlemen. Really nice work this afternoon. Thank you very much. Collin Martin, Jeff Kleintop, excellent stuff. And some really good stuff there in the setup for tomorrow's inflation print.